Today's business environment is full of challenges: climate change, technology disruption, political conflict, economic uncertainty, hybrid work, new business models, and trade tariffs. Raising capital has become increasingly difficult, especially in Indonesia. Only 40% of people have access to formal financial services. MSMEs and underserved groups are particularly affected. Loan interest rates are high, at 9 to 11% for Indonesian rupiah and 5 to 6% for US dollars. And most banks require strong bookkeeping, projections, and collateral in the form of fixed assets. As a result, even well-run businesses often struggle to access the funding they need. Over the past decade, Singapore's real estate market has been one of the best performing in Asia, delivering reliable gains and strong investor confidence. Why? Because their banks historically offered generous terms. Loan-to-value ratios as high as 90% at low rates. And property prices rose steadily, about 5 to 10% per year. Even a 10% rise in market price could double the investor's return on equity. This created a very attractive investment environment, especially for those looking for downside protection and consistent upside. First, borrowing restrictions. The total debt servicing ratio, or TDSR, limits your total monthly loan repayments to 55% of your income. So even if your property is worth millions, if your income doesn't meet the threshold, banks will say no. Second, loan tenure is tied to your age. If you're 55 years old, your loan must be paid off in 10 years, because banks require repayment by age 65. That sharply raises monthly installments and blocks many older owners from refinancing altogether. Third, loan-to-value limits decrease significantly if you already hold property. With no mortgage, you may get up to 75% LTV. But if you already have a mortgage or multiple properties, LTV can drop to just 15 to 35%. Then there are stamp duties, which make both selling and buying more expensive. Seller's stamp duty charges up to 12% if you sell within 4 years. The additional buyer's stamp duty hits foreigners the hardest, starting from 10% years ago and now reaching 60%. The impact of these regulations has been clear. Speculative flipping has declined, transaction volume has slowed, but property prices continue to rise. The result? Owners are wealthier on paper, but unable to borrow or sell without huge financial consequences. They are, in essence, locked into their assets, with large unrealized gains they can't use, especially when they need capital the most. As their business needs grow, many Indonesian owners struggle to raise additional funds in a cost-effective manner, even while holding high-value assets in Singapore. That's where structured alternative financing becomes relevant, offering a way to unlock equity without selling and without violating these restrictions. So, what can these property owners do? How can they access the equity they've built without triggering taxes, age limits, or lending restrictions? The answer lies in a business loan structure, one that uses your property as collateral, but bypasses all the usual roadblocks. Here's how the structure works. First, you set up a private limited company in Singapore. It can be newly created or an inactive one you already own. This company becomes the borrower, not you personally, which allows the loan to be treated as a business loan, not a mortgage or personal loan. Next, you use your personal property in Singapore, which remains in your name, as collateral for the loan. A non-banking financial institution evaluates the property's value and agrees to lend based on a percentage of it, typically 70% to 85% of market value. You are required to sign a personal guarantee, but the property is never transferred or sold. You also continue to earn any rental income from the property. This structure bypasses restrictions imposed by traditional banks, like TDSR limits, age cutoffs, or income documentation requirements, because the loan is issued to your company, not to you. Once approved, the loan is disbursed within 4 to 6 weeks, and you can use the funds for any business purpose, whether it's expansion, operations, paying suppliers, or refinancing other obligations in Indonesia or elsewhere. It's a clean and effective way to unlock the value sitting in your overseas real estate without selling your asset or paying huge taxes. This model allows business owners to unlock overseas equity quickly and flexibly. It avoids all the typical hurdles, TDSR, income documents, age restrictions, while offering affordable rates and fast disbursement. You also retain rental income and your ownership rights. If you're looking for capital but traditional options have failed you, this is a proven, practical alternative. A similar financing structure can also be applied to properties in Hong Kong, Australia, Malaysia, and even Indonesia, depending on the asset and lender criteria. You've built the value, now it's time to use it. To explore how asset-backed loans can work for you, contact us today.